Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go into the EIA numbers and really look at what happened and what's going to happen going forward. So we're going to focus on some economic data and some other things, as well as obviously the Primary Vision Frac Spread Count on Friday, but we really want to focus and dig into this EIA report because we think it is very important as to what's going to happen going forward. Now, when we look at the crude stock build, you can see that on the top line, it looks like there's a draw. But remember, you have to include the SPR, which is just the Strategic Petroleum Reserve, because that's where we've rented out space for companies to put their oil. So here you can see that there was actually a total build of 1.94 million. Now, this is something that's going to continue to remain elevated, but it's being really driven by Pad 3. We saw Cushing coming back closer to the average, Pad 2 coming down as less Canadian imports are coming in. But the big focus is going to be Pad 3 because that's where we still have a huge amount of Saudi crude coming into the Gulf of Mexico. Now, let's focus on crude oil production for a moment. We saw another decline to 11.2, and we have the supply adjustment at about 1 million, which means that we're about 10.2 million, which should come down a little bit as the hurricane progresses forward. It's already made landfall in Mexico. It's supposed to come, right now north through the Gulf of Mexico, and some platforms are already being evacuated, which will be a short-term dip in terms of Gulf of Mexico production, which should show up in Pad 3 and could create a little bit of timing delays in terms of things onboarding and exports. But we really need to dig into the total inventory number, which you can see is approaching all-time highs. Now, this is going back to 1991, which just to show you in aggregate, what this really looks like and what the average is. So we continue to see this slow progression, but you also need to consider that we have refiners that are operating at minimal levels, and it's increasing the amount of product in storage, which we'll talk about in a little bit. Now, I talked about Pad 3. This is why it's so important. We're now at new all-time highs in terms of inventories coming in. We have some crude coming off the water, but floating storage is still above normal, and that all has to be onboarded. But there's going to have to be a balance between onshore and offshore to make sure that we're not overfilling the system, and there is that timing delay. The problem is refiners are going to have to reduce their runs if we continue to see these current numbers, which we believe. Now, when we talk about those current numbers, this is what we're referring to. So when we look at imports, you can see the imports were down, really driven by Pad 3, 4, and 5. But let's just focus on 3 and 5 for a minute, because 3 and 5 is where we have the Saudi crude just sitting there. So the pace is always going to slow down. You're going to have these ebbs and flows because there's timing delays in terms of getting all this stuff onshore. So this is something where we'll see an increase, a little bit of an increase as we go into this week into next week, as we kind of backfill some of this system. But the bigger issue is going to be runs. So when we look at the crude runs, you can see that we've had a small uptick to 71.8%. But we think we're going to see that either flatten out or come down, really driven by Pad 3. And it's purely because we've already had some upsets, but there's just no place to put the product. Like we're running so high on refined product storage that there's just no place to dump this, because as you can see, implied demand continues to struggle. So implied demand for distillate is a big focus, and gasoline, as you know, for us, because these are the two that are really going to dictate kind of what's happening in the world. We know jet fuel is going to continue to be terrible. Now we're banning Chinese flights landing in the U.S., which is obviously going to create more strife, more issues, which is just the tit for tat going back and forth with the Chinese trade deal. But the implied demand and runs are something that we really want to focus on as we kind of break this down a bit more. So when we break this down a bit more, you have to look at, these are the imports that we're talking about. You've seen a small dip in terms of what's actually in the Gulf of Mexico, but we're still above where we should be right now. So this is something that's going to continue to come down, but the pace has to adjust accordingly. So when we take this a bit further and look at the oil import data, you can see that we were right around average. We kind of normalized a bit. And the reason why it seems like, well, why isn't it higher, It's because it has to marry with the runs in the area. So as refiners continue to operate at essentially, levels that they need to stay at just to be operational and to actually keep the machines on, because there's a volume limit. So you need to have a minimum volume in the actual processor before you create a flaring event. So there's a minimum that has to be going in at all times. And right now they're essentially at that minimum. So you either turn them off completely or you increase. And that's where we're sitting right now. So there is a chance that you could start to see some of these refiners shutting more units because there's just not the demand there. And that's why the imports look low, because the refinery utilization rates are low. So this is something that's going to kind of waffle and bump around that average. Now, when we look at the utilization rates, I keep saying that, but what does it mean? And here you can see just how bad it really is. Like typically around this time, we're at about 92%, and currently we're at 71.8. And realistically, we should actually fall back closer to 71. We think that you're going to stay between 70 and 75%, but this is kind of where we're sitting right now, and we're still right at that Hurricane Harvey, which is that big down move right there. We're just stuck there, and that's going to weigh on total oil demand. And when we think about products going abroad, we have to consider exports. And that's why when we look at distillate, we continue to see those exports continue to fall. And the exports continue to fall, which is actually pushing back and just showing the total pain across the board. Because this chart right here is really looking at U.S. demand. So not only are exports terrible, which we'll talk about in a little bit, but we also have falling demand. And this is a way that we really focus on and look at industrial production as well as supply chain. So this demand continues to come down, and we think it'll probably take out 91 and 92 next week, because the two low numbers, which is setting that bottom of the cloud, is 91 and 92. So we're already at this point of just continued slowdowns, specifically on distillate. Now, a big focus that has been on gasoline. So gasoline had a little bit of a bump, which is good, especially after the slow start to the season with Memorial Day. But we're starting to see a little bit more movement. Now, this is going to be hindered based on urban issues when it comes to protests and people trying to avoid some of these areas. So there's going to be kind of this waffling right around. We've thought about between 7.5, 8 million barrels a day is the new normal, and we kind of think that we're getting right to that level where we'll start to see a leveling off. And it's good to focus on and look at gasbuddy data, because gasbuddy data tends to be more agnostic. Like people will look at Apple data, but think of who owns iPhones, which class of people. So it's hard to say, because those individuals typically have more mobility. And this we think is a bit better, because it shows not just the EIA, which is more to the rack, which is where the actual tanker loads up, but this is actually at the pump. So we've seen an increase of about 5% to 15% across the board week over week, but that's still 30% down year over year. And that's the bigger point, is that 30% down year over year, that seems to be sticky. And the problem is the comps are going to continue to get harder as we go through driving season. So these are key factors when we're considering where oil demand is going to go. And we just think that there's actually going to be downward pressure on total oil demand as we go forward through the rest of the summer. Now that we've gone through some different components on what's happening onshore, now let's look what's happening offshore. We've been talking about the pressure within Latin America, within Europe. Europe is now at I think it's a 2018 low for product going down into West Africa, and will trend lower just because Africa is also obviously not seeing the same kind of demand. So this is going to be a problem, because European product has to find a home, and it's not finding a home in Africa, and it's not finding the same kind of home that it has been in Pad 1, which is the East Coast. So where is our product going to go? Because now you have more competition. So this is why we keep focusing on distillate and gasoline, because that's really where we're going to see more pressure across the export market. Now, I don't know if last week we talked about how we were going to see a drop in U.S. exports as the crack spreads continue to struggle using U.S. oil. So if you buy U.S. oil, which is typically at Magellan or Louisiana light sweet, you're going to bring it to your refiner and you're going to have to make product with it. And right now we've been at anywhere from -$6 to -$8. So the pressure here, you can see we went from about 3.1 million to 2.8 million a day. That's going to remain relatively sticky for, we think, for the next week or two at least at 2.8, before we actually continue to drop further and to go closer to 2.5, which is a healthy number, just kind of given where we sit in terms of what is the demand for U.S. crude in the export markets. So just to really dig in and understand, well, how bad is some of these export numbers? And you can see the gasoline exports here. Gasoline exports are bumping right along all-time lows. This is obviously going back to 2011 just because of the shifts in the market. And there's very little to support new increases because now we're competing more than ever against European product. And we have Asian products, specifically India, coming into our markets as well, as the Middle East is kind of jockeying for different flow. So gasoline is going to continue to hit new lows. We think we're going to hit new lows either this week or next week, and that's going to progress going forward. Now, distillate is something very similar. We're bumping right along those bottoms, and this is something where we had a nice increase. I think it was 2 years ago that kind of got us off those lows. It's just we're not going to get that kind of benefit because there's more and more product that is just competition at this point, specifically from the Middle East and Russia, which is an interesting tidbit that we'll touch on in a few minutes. Now, I talked about the builds, and it's important to understand how bad are these builds. And when we look at gasoline and distillate, you start to put it into perspective. Gasoline had another build of 2.8, distillate of almost 10 million. And it's important because this is where things are going to sit. The U.S. has some of the most storage in the world, so we're the inherent dumping ground for some product. And as our demand remains, very low, as global demand remains low, you're going to have more competition as more crude comes into the U.S. and refiners try to understand, well, how do I keep things operational while not trying to overwhelm the system, essentially. So distillate continues to be a focus for us. We think PADD 2, which is just the middle of the U.S., is going to see more pressure just because planting season is over, things have gone well. And diesel is just going to be a huge headwind going forward. And gasoline, this was supposed to be drawing. This was what everyone was focusing on when the crude was rallying, and now we're starting to see this slowdown. Now, we would be remiss if we didn't talk about OPEC and the fact that the May cuts and June cuts, which were about 9.7 million, they were supposed to have a meeting tomorrow. Now, the meeting was postponed because Saudi wants a 3-month extension at 9.7. Russia wants a 1-month extension at 9.7. And there's also an issue of this little thing called Nigeria and Iraq cheating. Now, the compliance for the 9.7 million was only 77%, which means we were over by 33%. So somebody's cheating. And here, I think this is a great graph in terms of showing, look how bad Iraq and Nigeria were in comparison to where they should be. Now, this is going to be a problem because this was May. We should have been there already in June, and now that you have July. So when we look at July, and we have to consider, okay, well, what is July going to look like? Because July, this was supposed to go from a 9.7 million barrel cut to 7.7. So we're going to see that extension, at least for a month at 9.7. And Nigeria, just even on the new numbers that they've put out, they're still not where they should be, because they should be at about 1.4, and they're right now at 1.6. So this is going to remain a problem across the board. Now, when we look at why is it going to be a problem, we can look at the U.S., Japan, and Fujairah in terms of crude and distillates. The pace of builds has accelerated, mostly driven by Japan. Fujairah had a big increase as well. but Japan had a big rebound in oil and storage and distillate and storage, and the US is the same. So the problems are going to remain across the complex when we look at where things are going. So when we look at how pricing is going to be, we think that there's going to be pressure across the crude contracts. Realized prices remain problematic, and we think that you're going to see this pressure come into WTI. Now, what does that pressure look like? We filled some gaps. We've started to see some normalization on a technical level, and we think some of the pressure is going to come in as uncertainty happens within OPEC. So now that we've covered the EIA and what's been happening throughout the U.S. system, and we're started to touch on OPEC, on Friday, we're going to go through in a bit more detail on the different employment data, economic data, and then everybody's favorite topic, the primary vision frac spread count. So thanks again for watching. Any comments are always great. We like to have some dialogue. So please subscribe, share, watch us as much as you want, reach out with questions. And again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.